Kyle, hello, good to see you. What is IRMAA and how does it affect what you will pay for Medicare Part B? If the Social Security Administration considers you a high-income beneficiary, you will pay a surcharge known as the Income-Related Monthly Adjustment Amount. And how high is high income?
Yeah, Aaron, thanks for being with me on this one. This is a big one. And the answer to that question is that the income is not as high as you'd really think.
No.
This is looking at 2024 incomes as it relates to IRMAA in 2026, because there is a 2-year look back. But if you file a solo return, if you're making over 109,000, or if you file a married filing jointly return, 218,000 or more, now you're in this the rich category, so to speak,
Right.
when it comes to Medicare Part B, and it can be very punitive. So I mean, if you look, that bottom row there, if you're earning 500 or more as a solo filer, or 750 or more as a joint filer, you could be paying upwards, right around $689 a month instead of 202
person. Yeah.
per person. That's right, per person.
Yeah,
So
and Kyle,
it's
I think
a sneaky one.
a lot of people don't realize too that IRMAA is a cliff, $1 too much, and you're paying a completely different premium.
Yeah, exactly. So it's not like it's a prorated, formula. It pretty much is, hey, if you make over this amount, you're stuck now in this bracket for 2 years. And then, so it's a 2-year look back and then a 2-year punishment, so to speak, for triggering that threshold.
Right. And so I just to point it out again, so people can see here. So your 2026 Part B premium based on your 2024 income, that's the 2-year look back. So without proper planning, you may have to pay IRMAA because of a one-time financial event that happened 2 years ago. Walk me through some of those events that bump up your income.
Yeah, and honestly, this is one thing that I think surprises more people than anything else in our financial planning world, if you will. But IRMAA, that is. Now, the one thing I've had recently, a client we had just met, they were like, hey, I just sold all my investment properties as I'm getting ready to retire. And I got this letter and I have to pay all this extra money now. The sale of those properties that they've held for a long time, those capital gains actually counted towards that IRMAA calculation in their case. So it's something you want to be mindful of: selling properties, selling a business, big repositioning in a non-IRA account. If you have a lot of gains in there, you want to be mindful of it. And here's the real sneaky killer when it comes to this. It's the RMDs, required minimum distributions. Right. A lot of people save most of their money in pre-tax accounts. When you turn about 73 or 75, depending on when you're born, you're gonna have to start taking some of that money out each year. There's the chart. Depending on when you're born, that's when you have to take that money out. But if you've accumulated a healthy amount in your IRAs and you're not actively peeling that amount back until you turn RMD age, RMDs may put you in those IRMAA brackets passively each year. And that could be a sticky spot to be in.
Right. That's why there are a few strategies that people can start thinking about now to reduce the chances that they'll be hit with IRMAA. Just because you mentioned RMDs, let's start with Qualified Charitable Distributions. How do these work?
Yeah, so this is a nice strategy. It's a way for you to basically take money from your IRA and gift it straight to a charity, instead of basically skipping yourself right in that equation. You just want to go straight from the IRA to the charity. It's got to be a qualified charity, a 501c3. But a lot of people, most common example is the tithes to the church. Right. One creative way to look at that is, instead of paying that out of your bank account every year, you could pay it out of your IRA if it's appropriate. And then that money that leaves the IRA goes to the charity. It's not taxable in that case.
Essentially, give that RMD to the charity. I love that strategy. So, and then you mentioned how a lot of us are good savers in our traditional accounts, which require the RMDs. But if we can strategically do Roth conversions, Roth accounts don't have any RMDs.
Correct. Yeah, they don't have any RMDs. And if you meet all the criteria with the Roth, meaning that it's funded for more than 5 years, and you're over 59 and a half, et cetera, you can access that money tax-free. And so when you're pulling the qualified Roth distributions out, as you're taking that money out, it's not going to count towards your taxable income for the year, and therefore not count towards IRMAA, which is excellent. So we love to try to get ahead of the curve with the Roth planning. You don't want to start trying to do that when you're 73. You want to try to do that ahead of time and really give yourself time to do it.
Right. And then the last strategy that we wanted to talk through, health savings accounts. And as we talk taxes, these are uniquely triple tax advantaged.
Yeah, these are great for the people that qualify for them. You know, if you've got a high deductible health plan and, you know, you meet all the criteria for one of these accounts, you know, the money going in is tax deductible on the way in, but it grows tax free. And then if you're withdrawing it for the qualified expenses, things that qualify for the tax free withdrawal, it's tax free coming out. So it's a great way to save and kind of stagger your tax bill that you would normally have if you went all pre-tax on your savings.
Yeah, IRMAA is just so interesting. It's very much about threading the needle, considering the 2-year look back and the $1 cliff. And this was the steepest learning curve, I think, for me, Kyle. So if somebody would like to sit down with you, make sure that they are not surprised by any IRMAA surcharges when they are Medicare age. What's the best way to reach you with questions?
Sure. The best way is through our website. Go to firstcoastfinancialgroup.com, and we'd love to connect with you through there.
Great. Kyle, thank you so much.
All right. Thanks, Aaron.